Hello and welcome to this week's instalment of Nucleus Investment Insights. This week we are joined by Caroline Di Russo, who is a commercial lawyer specialising in complex commercial disputes and corporate insolvency and reconstruction. She has acted for top-tier banks, insolvency firms, Australian and international oil and gas producers, construction companies, energy providers and mining companies. During 2017, her main hustle became her side hustle, and she is now mostly devotes her time to her luxury goods e-commerce businesses and having a rollicking time as a columnist, broadcaster and politics junkie. Caroline joins us today to share her expertise, thanks guys, on corporate insolvency, which we believe could be a major piece to the puzzle in bringing runaway markets back down to earth. Additionally, she'll be sharing her views on why luxury goods have seen an increase in demand during the pandemic. Finally, we'll also be discussing what the government might do from a policy perspective to help steer the economy through this downturn. Caroline Di Russo, welcome to Nucleus Investment Insights.
Thank you for inviting me, guys.
Wonderful. And as always, I'm also joined by Nucleus Wealth's Head of Investments, Damien Klassen. Hello, Damien.
Hi, Tim.
Fantastic. And just a quick reminder that before we get started, to subscribe on YouTube and click the notification bell to be notified of when we go live or have a new webinar to watch. And follow us on your preferred podcast platform. And for those listening in live, feel free to drop in your questions in the chat box below at nucleuswealth.com/webinar. So let's jump into the agenda. So we're going to kick off, as I mentioned there, with insolvency. We're running through some bits and pieces on the luxury market piece as well, and then of course wrapping out with the government policy piece and what might be in store for us to help us get through this downturn. So I'll hand over to you guys, Damien. We'll kick off with insolvency.
Sure. Yeah, I guess, and I just want to sort of a little bit of a preamble as well for people listening in. It's a little bit I guess eclectic this time around, because what we're trying to do is hone in on things that Caroline has experience in, and we've been looking for people in the insolvency side of the market, because we're really trying to get a better feel for what's going on at that side, and we've got a few other guests coming up in coming weeks, sort of trying to really look and get sort of a forward look at what's happening there. But we also thought, because Caroline's a bit of an expert in that luxury market, I've got a bit of a shopping list of companies that I want to buy, and a number of those companies are sitting in the luxury market. And so just wanted to make sure that wanted to see what insights we could get from there. And so there's not really a direct link, other than that Caroline's got a significant exposure in both. And so I wanted to really tap her brain on both of those. And then also, she writes a lot in the Spectator and on policy. And so getting some ideas from there would be great. So I might toss quickly so we've got a chart up just showing so the US corporate debt to GDP, and that it's basically higher than it's been any time in the last sort of 50 odd years. We've had a bunch of different policies put into place globally in terms of preventing companies from not preventing, but helping to slow down the wave of insolvencies, with the view that if coronavirus was only a short sort of shutdown and start back up again, we didn't want to see companies going broke, only then to find back 3 months later they were actually back solvent again. And so you sort of not having to go through that whole close things down just to start them up again. But we're starting to come to that end of that period. And Caroline, you wrote a piece just recently talking about companies being in cotton wool. Maybe do you want to give a quick summary of that, and then we can jump into some of the thoughts behind it.
Oh, yeah, sure. Absolutely. Look, the piece that I wrote dealt with the temporary changes that the federal government has put in place to the insolvency laws. So there is a change in relation to bankruptcies as well, but that's personal. So let's stick with the corporate side. So statutory demands, that's when you essentially serve a statutory demand notice on another company. And for a debt that is owed, the threshold used to be $2,000, it's now $20,000, and you used to get 21 days to pay that money. Now it's out to 6 months. So essentially what happens is, if you don't pay that debt previously within 21 days and now 6 months, the company is deemed to be insolvent. So your creditor can go to the federal court and put in a creditor's petition to wind up the company, because it's deemed to be insolvent, and then that company, that becomes what we call a forced insolvency. So you know, that there is one way that companies enter into external administration. What we have seen, because that threshold has now gone out to 6 months, there is a whole bunch of companies which would have otherwise gone into external administration which aren't. So they're kind of, you know, you guys talk about it before, zombie companies. They're kind of sitting there. They're probably insolvent, but you know, that nothing is being done to force their hand, so they're just staying the way that they are. Similarly, there's also been temporary relief for directors for personal liability for insolvent trading. This is a big one. So if you're a director of a company, you're required to put that company into voluntary administration if you believe the company is trading while insolvent. And if you don't put it into voluntary administration, then you become personally liable for losses that are suffered. So those changes have really, I suppose, put the brakes on, I guess, you know, companies go insolvent all the time, not necessarily related to downturns, not necessarily related to COVID, but just in the general course, companies do go insolvent. So it seems to have just put everything in cotton wool, you know, pending, I suppose, the outcome of whatever this, you know, this shutdown was. And you can appreciate how at the point that we were in March, that there was not necessarily an unreasonable thing for the government to do. I don't think it's going to achieve what they hoped it would achieve, but you can kind of appreciate why they did it.
And if it had have been if we had have come out of the lockdown and everything was fine and we're back to, say, a WA type economy or a New Zealand type economy now, then there's more of a reason for them to say, yes, that was a success. But the fact that we're starting to go through this second wave is, So what do you think they're going to do? Like in terms of the, as this deadline gets closer, so it's a September deadline?
Yeah, it is. It's the end of September. There was 6 months. There was a 6-month moratorium put in place. Look, my preference, I suppose, is that there isn't an extension to this, simply because where you've got companies that owe other companies or other creditors money, it means those creditors aren't being paid. So if those creditors aren't being paid, then those creditors probably can't pay their own creditors. And so we need to have money washing through the economy for the wheels to be able to turn. And I'm a little bit concerned that if we try and keep this suppressed for too long, it's actually going to be detrimental in the fact that, you know, a problem with one company is almost going to spread and affect the solvency of other companies. So the principal point for insolvency is that you become insolvent when you can't pay your debts as and when they fall due. Right, so it's a cash flow focused test, not an assets test. And I wrote about this in my article, that it doesn't matter if you've got a pile of accounts receivable. If they're all at 90 days and no one's paying your bills, it's irrelevant that you've got them as a current asset, because it is severely limiting your cash flow. So my preference is that there isn't an extension. As far as the relief from insolvent trading, I would prefer if it was changed to making it easier for companies to go into safe harbour. So in the last couple of years, we had safe harbour provisions put into our Corporations Act. And essentially what that does is it provides companies with, as it says, a safe harbour where you're trying to save a company from going insolvent. So say your bank pulls your lending, right, and you become unfunded. Well, it'll give you some time to be able to rearrange lending with another institution. And if you can get that lending, then it may tip you back into being solvent, as opposed to losing your bank lending and then going straight into a voluntary administration, which traditionally a lot of companies had to do, because if you don't have that bank backing, then you don't have that cash flow and that access to overdrafts. The only thing with going into safe harbour is that there are preconditions to it, and one of the preconditions is that you have to be up to date with your employee entitlements. And I suppose that's fine in the normal landscape, because there generally tends to still be money coming in. The problem with the current landscape is you've got a lot of companies or a lot of businesses that are totally shut down, and so that they don't have that revenue stream coming in to be able to look after their employees so that they can then go into safe harbour. And I take the view that while JobKeeper is in place, JobKeeper kind of does that job.
And in comparison, so the safe harbour is sort of similar to the US Chapter 11, isn't it? And so, but so I guess what I'm thinking is do you have a feeling sort of globally whether this is a sort of similar case, or are you not looking at much overseas?
I haven't really thought about it in a great context overseas. I mean, the US example is the closest example. I think we will see that. You know, they do call it bankruptcy protection, and they do that for a reason. And it just gives companies a bit of a chance to get back on their feet. Look, we saw, say for example, it's a slightly different, but we did see Virgin go into voluntary administration, and we saw well, so far, touch wood, we've seen quite a good result with the administrators being able to broker a deal and reconstruct Virgin so that it can come back out and be able to operate again. If safe harbour is the pre-insolvency position of being able to, in a sense, being able to do the same thing. So the more companies, in my view, that we can get into safe harbour to protect them from going insolvent, the better. And the reason that's helpful is because once a company enters into voluntary administration, everyone panics. Everyone panics, and it becomes public, and suppliers pull out, and then, you know, your landlord starts panicking, and your bankers, and everyone starts panicking. So to the extent that we can try and save companies before they go insolvent, or before they enter into external administration, the more chance you have of getting them going again without everyone losing their mind. And I think, you know, the same happens in the US, and I think that Chapter 11 will be relied on significantly.
Quick one, Caroline. So with safe harbour, in your experience, you mentioned how it gives companies an opportunity to find some money, or get some debt, or some, find something to get them going. Are they actually successful in that? Like if you went to as you probably as many people know, getting loans for businesses when the business is healthy is a bit of a task. If you're sitting in a safe harbour thing, I'm pretty sure you go right to the back of the queue, wouldn't you? Or is it? How does that sort of work? Just out of interest.
It does work. Look, we haven't, to be honest, had it in place for long enough in Australia to really be able to say how well it's working. But
and we haven't been through a recession either. In that stage.
We haven't been. We haven't been through a recession. So. Yes, it does work, but it's not always necessarily lending that is the issue. It might be that a company goes into safe harbour so it can sell an asset.
Right. Yep.
And once it's sold the asset, then it's cash back up. So it's that lending was just the one example, and it's usually the most obvious example because the bank does panic. But depending on the lending institutions, some have more appetite than risk than others, and it depends on the industries. So there is always opportunities to find other places to get lending, or to do a public raising of capital, or there's other ways to get funds into a company other than just like for like lending. And it just gives the companies that opportunity.
Sure. Okay, thanks for that.
But, I mean, the other thing is that occurs to me is that it seems a little bit, it's a little bit analogous to viruses in itself, in that if we're not seeing companies go bankrupt, it's a bit like not testing. You're sort of going, okay, we think things are going all right over here, but we've actually got no real idea. And then you do a bit of testing, and all of a sudden you're like, hey, there's a huge explosion, and all these people have got the virus we don't know about, and they're spreading it to other people. I guess what I'm saying is it seems a bit the longer you leave this on in the corporate market is, there's healthy companies that aren't getting paid by other healthy companies who aren't getting paid by unhealthy companies, but you don't know what the links are until you start actually causing the insolvencies. And then, the next the companies in the middle can go, well, actually, just a minute, we've lost all this money. We do actually need to take safe harbor and then, work out a payment plan with the next one. And everyone can actually know, okay, this is when my money's coming, as opposed to you're sort of sitting there with these unexploded bombs sort of sitting in throughout businesses everywhere.
And that is exactly how I feel at the moment with what's going on. Is everything is quite literally suppressed, everything is in cotton wool, but there has to become a point where we're going to have to lift the lid and have a look at what's going on inside. Look, we are going to be heading for a recession. That I guess how severe it is anyone's guess yet, but there's not enough information coming out for people to be able to make risk assessments for their own businesses. So you don't know if a company that you're supplying to, you don't know what their position is like. You can have no idea. It's only when maybe they start getting a bit late on their bills and then it starts being cash on delivery and that sort of thing that people start to get an idea within their immediate circle. But when you're starting to talk at an economy-wide level, we have absolutely no idea. The only thing that I can sort of, the educated guess that you make is you go back and you look at what happened during the GFC, which was a lot more contained. And then you go back and have a look at what happened in the early 90s. And in the early 90s, we never switched off the economy. We never switched off the economy. Yes, there was a downturn, but there wasn't that trigger event that stopped revenue coming in. And that there is the concerning part, because insolvency is so reliant on cash flow. The minute cash flow dries up, I mean, there just has to be that knock-on effect. And the thing is like I said, eventually the lid will be lifted. And an insolvency, unfortunately, it's a little bit like a daisy cutter. You drop that one insolvency and it has this ripple effect and it can flatten people around you really quite easily. And then that becomes, your problem then with employment, that becomes a problem with output, that becomes a problem with confidence, and it just seems to avalanche along. So the sooner we find out a little bit of what's going on, the better.
Yeah, and the other part that seems to me, and I guess I'm talking amateur psychology here, so I'm not positive this is going to happen, but it seems likely to me, is that there's a lot of, I feel as if there'd be a lot of small businesses in particular that were sitting there through the first downturn, through the first lockdown, and they were sort of like, I'm really doing it tough. I'm eating into my mortgage. I'm laying off this. I'm staff here. I'm trying to pre-fund JobKeeper. I'm just trying to keep everything alive until we can get out of this lockdown. And then it's like, oh, great, we're out of the lockdown. Okay, I can finally start tapping. Well, I'm not actually saving anything because we're back to 60, 70% of what we were before. And so I'm still keeping even. And then now we're in Victoria, now it's back into a second lockdown and potentially other places, is whether then that's when people just throw up their hands and go, you know what, stuff it, I'm out of here.
I just can't. Yeah, and that, we had talked about the second wave in this theoretical sense for the last 2 or 3 months. Now that it's actually happened in Victoria, we've all just looked at it and gone, oh, that's incredibly uncomfortable. And the thing is, you're right, those businesses that were like, if I can just hang on and everyone just does their part and maybe we can get through. But then it's now become the point where people are like, well, they have exhaustion. It's emotional exhaustion from just trying to keep everything going, from trying to keep, it's like trying to gather all the loose ends and just try and keep it all together, where there's a lot of people who are like, I can't sustain 6 weeks of no revenue again. We took such a massive hit to whatever the reserves were the first time around. I don't have the reserves for shutdown 2.0.
Yes. And it's also it's apart from I guess New South Wales is sort of pushing down this, but a lot of the US as well is where they're sort of saying, okay, well, you know what, because we don't think we can do a second round of this, because inflections are going up, we can't do a second shutdown. So now we're just going to have to put up with reduced income for the whole time. So sort of that, I guess. Sorry, let me start again. What we saw in previous pandemics is that countries that or regions that basically did this real harsh clampdown and got the disease down to zero, and then came out, actually did better than the ones that tried to keep all the businesses going, because they stretched things out, whereas the ones that actually sort of saved. And I guess that's where I'm leading to in this, is that it looks as if the US and potentially New South Wales seem to be headed for the whole, we're not going to shut down again. We're just going to have this going on for a long time of reduced income for everyone.
It's a little bit difficult, isn't it? Because when you're shut down, like I said, there's zero revenue going in. And look, I can understand why we had to shut down the first time. The hospitals had to get ready. They had to get all the supplies in. We still weren't really sure how we were going to treat this thing, ICU beds, etc. So I understand the first time round why we had to do that and why it was so severe. Going forward, though, I do wonder whether, now that we know how to treat it better and now that the hospitals are better prepared, we're starting to get a better idea of how many severe cases there are as opposed to non-severe cases, whether it really just becomes, I think, a bit of a balancing act. Yes, there's going to need to be restrictions in place, but the problem is how long do we keep our international borders closed? Because then you have the issue of, okay, we can get rid of it, say within Australia, but the minute we open our international borders again, there's a very good chance that it could return. Do we go into shutdown a third time, or are we going to have to learn to live with it to some extent?
Yeah. And that was the conversation we were having last week, is, what happens if Australia does shut, we get it back under control, so we're all clear, and the rest of the world was, Europe and the US basically have thrown their hands up and gone, oh, well, we may as well start traveling again because you've got it, we've got it. We may as well. And so the rest of the world's back traveling, and we're sitting here going in our bubble going, do we open? Don't we open? Like there's a, yes, it's a, okay. So coming back to bankruptcy then.
Yeah.
Do you have any sort of feeling on, I guess, issues? So it seems to me most small businesses, like an insolvency lawyer, is going to cost what, 20 grand minimum, I'm assuming.
Yeah, they're not cheap.
So, so you basically, if you're a small business, and if a small business owes you money, the insolvency guys are basically going to take whatever's left, and you're lucky if you get anything. Is that?
There is a little bit of that. I mean, so the lawyers, we don't go in. First, it's the insolvency practitioners, which are the accountants, because they're the ticketed liquidators and administrators. So they go in. The lawyers only get brought in if there's a deal to reconstruct or there's something to fight over. If there's nothing much in a company, they generally tend to get tidied up pretty quickly. And a lot of cases, by the time a company goes under, and particularly retail, right? There's not much to sell. They actually don't have much of an asset base. What I think will be interesting is who is the catalyst for kind of kicking off these statutory demands and creditors' petitions. So I think it won't be the really, really small debts or the really, really small business sector, because a creditor's petition, to put that in, you are looking at about 20 grand, 15, depends, on just getting someone to go into external administration. So depending on the value of the debt, it's probably not worth it. I think we're probably going to see it more in that middle part of the economy, so your bigger small businesses, and then all the way through your medium sector, where people have got 200-300 grand owing. You will see more there. I think the banks and the ATO are probably going to try and give people as much leeway as possible, at least in the shorter term. I know the banks, Matt Commons said, I think it was last week, that, you know, they're going to try and help people through to the end of the year. So that will hopefully, once, you know, restrictions lift a bit more, it will give people a little bit of a chance to get revenue flowing again and get back into the insolvent territory. But there will probably become a stage where you know, banks do start appointing receivers, and the ATO does start winding up, you know, forcing insolvency. So I think it's going to be different types of creditors at different stages over, say, the next 12 months.
See, the banks to me are basically, though, they're not really lending to small and medium businesses. All they're doing is saying, do you want to put up your house? Yeah, okay, we'll take, like, it's not like they're doing any cash flow or anything like that. All they're doing is just lending against the house. And so it sort of seems a bit 0-1 in terms of saying, yeah, I can see the banks going, okay, you know what? You gave us your house, you had a 60, 70% LVR. So yeah, we're pretty good for now because the house prices are down 5%. It's just a problem if house prices start to get out of control on the downside, then all of a sudden the banks might start tumbling over themselves to going, just a minute, I need to get this guy to sell his house. I need to take this over and sell this house, but while there's still some equity left in it before house prices fall another 10% and I'm cleaned out.
Yeah, exactly, because you're going to see that reduction in the security that's underlying whatever that small to medium business lending is.
Yes. Okay.
Quick question there, Caroline. Obviously, there's been some recent reworking, I guess, of business registers, and now we've got this prospect of director identification numbers from memory. And this is sort of just harking back on it just in the preamble there when I wasn't stuffing it up. We're talking about you've done some work with construction companies. And obviously construction companies love a good phoenix where they're, you know, quietly shifting assets into the new, you know, PTY. And then, you know, obviously there's a fair chance we might be seeing a fair bit of that given the lack of, you know, immigration and, you know, obviously home building and whatnot. If ScoMo can't, you know, re-kick the housing market up again. Do you think, just some thoughts on that, if you've covered that recently? Obviously it's going to try and slow down the phoenixing because a director can't just have this string of busted companies, you know, behind him or her.
Look, and construction is notorious, building notorious, and we do see it all the time. It has been a massive problem. I think the idea is a very good idea. The only thing that I'm concerned is the way that the legislation is drafted, and I don't have it in front of me, but it's not really limited to phoenixing. So there are other reasons that companies go bust or other people go into new companies and whatever that are totally appropriate, decent and not underhanded. And depending on their circumstances, it could potentially get caught in the phoenixing legislation. But as far as the phoenixing problem itself goes, I think it will be helpful because it has been a huge problem for such a long time. And we see it, you know, company goes broke one day, it's got creditors everywhere, employees don't get paid, and the next day they pop up, you know, and it's the same name except it's got open bracket WA close bracket before PTY Ltd, right, and off they go again. So I do like the idea of the legislation. I think it is really important, but given how many other companies are going to get caught up in this downturn and could potentially go insolvent, there is the possibility for a bit of bleed and unintended consequences into other companies that go bust where they're not really phoenixing,
right?
If that makes sense.
Yep.
Yeah. Well, and part of it is, you know, somebody goes bust. You don't want to make sure that you don't want to have that guy out of work as well because he's so restricted by what he can do. You want to go, well, okay, if they can actually get back to working somewhere and doing something, then So
exactly.
In terms of the sectors, then, so we spoke retail is obviously going to be a bit of a ground zero for this one, and I suppose that's going to flow on to some commercial property sides as well.
Yeah,
absolutely. Construction. Any other sectors of interest that should be keeping an eye on?
In relation to insolvency or in relation to phoenixing?
No, insolvency.
Oh, insolvency. Okay, so I think there will be a hit to retail, particularly where you've got that medium level retail in premium premises. I think that there's going to be a bit of an issue. Rents are high, and particularly where those businesses don't have an online presence, I reckon I'd be pretty nervous. I think we are also going to see, obviously to an extent in tourism and to an extent in hospitality, there being insolvencies there. The problem with all those three sectors, and like I mentioned earlier, is there's not much to sell once they go insolvent. So if there's a chance of a reconstruction, that would always be the preference, because you can at least get something out of it. The problem is when retail or when a restaurant goes into liquidation, there's very little to sell. So that there becomes the concern of, okay, going insolvent is one thing, but what's the dividend to the creditors going to be? And often those insolvencies tend to hit pretty hard. They're probably my three sectors. Aviation is tied to tourism. Yeah, hospitality, retail, they're the ones I think that will struggle the most.
Yeah, right.
And you was speaking off air just quickly beforehand. You're saying it seems pretty quiet at the moment in insolvency land. So it's the calm before the storm.
It is. It is absolutely the calm before the storm. Yeah.
So what are the forward indicators? I guess that where are you looking?
Well, the thing is, none of us really know. Like you said, we know it's all gone into mothball, but we're not testing, and because there hasn't been any testing in the market, you almost don't really know exactly where it's going to come from. I think reporting season will be interesting, because we'll get to have a little bit of a look to see how, particularly in the bigger publicly listed companies, how they're travelling. Of course, it's the big private companies that are the ones that everyone wants to get the VA job on, and that there is probably a little bit more difficult to get some visibility into that. But I think it will be in and around those sectors, and I think it will be look, some of those sectors have done reasonably well in cutting back costs. Those people that just acted really quickly and just went, okay, how do we stem the flow as much as possible? But then, we're talking about construction just before. I've got a friend who's a builder here in Perth. He's totally flat out because the government has offered state-based stimulus, and then there's home build out of the federal government. So if you are I think it's a first home buyer and it's a new build, you can receive something up to like 69,000 from the state. Now, don't quote me on those figures. I'm pretty sure, but it's a very significant amount. So he's signing up building contracts left, right, and centre, and it has gone through the roof in the last couple of months. So there might be some construction, but I think that smaller housing end is probably going to be okay for the time being here anyway in WA from what I'm hearing on the ground.
Yeah, because that's part of one of those themes we've been talking about over this coronavirus is that we've got, and it actually segues relatively well into the next topic, which is that it's not evenly spread. Like there's this whole part where people who can't actually get out and travel manage to keep their job, to a white collar job so they can work from home, manage to we're actually saving more money, and so have got more scope to it. And so it's that part about the uneven spread now means that you've got these bombs going off in people who are unlucky enough to lose their job or in the wrong industry. But on the flip side, there are people out there who have money to spend if you can get the product right for them.
Yeah, absolutely. And there's also those people who are not going on their summer European holiday.
Yes, exactly.
So they can't travel, so there's the extra money there. You're not driving to work, you're saving on petrol. Like even those small things, sometimes I don't think we realize how much money we save just from not attending the office.
Yeah.
parking and whatnot. It doesn't sound like a lot, and I feel like I'm talking about small fry, but in a sense, when you add it up over a period of time, it does become material.
Yep.
So
Absolutely.
I think those people that do have jobs who are working from home who can't travel, they probably are in a better position.
Yeah, and there's a few $100s worth of, I went to the pub and spent way more than I thought I was going to, and planned to, but I haven't been to the pub because I'm not allowed to, and so
right.
So what do you do?
Right.
You buy handbags. Isn't that?
You buy luxury handbags.
Well, yeah. So let's move on to this luxury part, because what I'm interested in there, and just to put that in context for people as well. So I think I spoke about saying I've got this shopping list of companies. We're trying to find high quality companies, good margins, and that we want to buy when they get cheap. And so I've sort of got this reserve list that sits there, and I usually these companies are horrendously expensive, and when the markets fell, I picked up on a little bit of Moncler, because that was sort of one I'd had on my radar for a bit, and there was a couple of others I thought about pulling the trigger on and never did, and now they've shot back up again. But but what's really clear, and I've got a chart up here of a bunch of different brands, a bunch of different listed companies, and just how much their forward earnings has fallen since the crisis sort of started, or I've just used the end of January as a benchmark. And to me, it sort of seems that the real premium brands, or maybe not even premium, I'd call them exclusive brands, where they basically don't, they purposely don't put enough out there and just charge way over and above. It seems like those ones are certainly doing better than the ones that are probably more of a mass market luxury brand. I just wanted to sort of run that past you, so Caroline, maybe you can give a little bit of background as to what you do on your website, and then talk about.
Sure. Not a problem. So I deal in pre-loved and vintage luxury handbags. So I'll talk about things from a handbag point of view, but feel free to switch in watch or menswear or whatever. I will talk in handbags, but generally when you're talking about luxury, similar kind of rules apply. So this is not exclusive to handbags. I am having a look at your list. I'm quite, when I look at that, in my mind, that looks perfectly normal. Like, that looks perfectly reasonable given the market. So if you look at the two brands, or the three that have dropped the least, Hermes, LVMH and Kering, they are the brands, or they are the conglomerates, I suppose, which hold most of your very exclusive luxury brands. So the thing with luxury goods, and if I can just in like a broader sense, the luxury houses are all different. They can be multi-faceted, and they can have very different entry points and, I suppose, top level points. Similarly, the luxury consumer isn't a monolith. So if a person who buys Hermes, it won't necessarily buy a Swatch watch, okay? And you can generally break that down. I give it a kind of a 3-tier breakdown into the psychology behind the luxury consumer. Similarly, just because something is expensive doesn't mean it's exclusive. And this is a bit of a mistake that a lot of people make. They think it's expensive. Well, so therefore, it's an exclusive luxury good. Well, you can walk into Chanel and buy a handbag. It'll cost you $12,000. But if it's in the shop and you've got either 12 grand in cash or 12 grand space on your credit card, you can buy that bag, no drama. If you want to buy a bag from Hermes, Hermes actually oddly have an online store, but it has very little in the way of leather goods on it. It's more like scarves and silks and that sort of thing. But if you want to buy, say you want the ultimate, you want a Birkin from Hermes, you can't just walk into the shop and buy a Birkin. So normally, and there's no real rule, but it's kind of custom, you need to spend about 35,000-ish, 20, 30, depending how much the person who looks after you likes you, 25, 30,000 over the course of a year on non-handbags. So on silks, on shoes, on that sort of thing. Then at some stage, and you might only get a day's notice, you will be invited to purchase a bag. So you'll go in, and it might be a bag, not the style that you want, the color, the hardware, or the leather, but you'll buy it. And you'll pay $15,000 for that bag, and you'll buy it, because if you don't buy it, you'll never get offered what you actually want. And so then maybe down the track you will get offered what you want, and there's another $15,000, but you've spent $60,000 to get the $15,000 handbag you want. And I know this sounds ridiculous. It's like the Hunger Games of luxury goods, but so that there is often how you get to buy your Birkin in store. So that there is not only expensive, but it becomes incredibly exclusive to buy directly. So so the people who are already in that market, they've already gone through their Hunger Games, so they will continue to buy, because even if they halve their wealth, they don't have to choose between a Birkin and paying the power bill. Right.
Yeah. And it's not the person who's sitting there going, they're 21 years old with their first job, still living at home, going, I'm going to save up every single penny I've got, and then I'm going to rush out and buy a handbag on it. They're not being allowed to buy the handbag they want at events.
No. And when we're talking about popularity, in a sense, there are some online surveys that have shown that this year Hermes has dropped a little bit in the amount of searching online and the amount of mentions in social media and that sort of thing. And I think that's because that social media is largely driven by millennials, and they're the people who are either looking at going through the Hunger Games to get their Birkin, or are partway through the Hunger Games to get their Birkin, and have just gone, Barley's can't play this game while, I feel like there's insecurity in my job, or watching what the market's doing. So they're actually pulling out of the race, I suppose. But in the sense of the actual Hermes fundamental buyers market, they're already in and they're still buying. So I think that's why you see that there. LVMH is similar. There's some very interesting brands that sit in there. They obviously cover booze, and so they've got Dom Perignon, Hublot, Sephora, actually, which I didn't know, Pinarello, which are bicycles, Chandon, Veuve Clicquot, but they also have Givenchy, Loewe, Celine Moynat, and they are all that much higher level of exclusivity. The particular one that's interesting there is Moynat. Now, they are a French house. They were established about the same time as Louis Vuitton, but it's incredibly difficult to buy a Moynat. And that there, I always call it the European old money label. Very beautiful handbags, incredibly well made, but very subtle and very elegant. And they're not singing about them in rap songs. So they don't have the same kind of market or open market push as something like Gucci would have, which is owned by Kering.
Yeah. And also keeping in mind, just for people listening as well, is so this is a one dimension. There's sort of three dimensions to this part. One is I'm looking at how much earnings are holding up, which is a sort of, to me, is a quality measure. There's a quality of the products they're selling and their business model, which is sort of what we were discussing. The other side, which we haven't discussed, is valuation. So that's the part where Hermes is, I think, up maybe at least 10% on where it was before the crisis, probably maybe even more than that. So some of these, if you can pick up a stock that's still quite good, but it's down 30-40%, it's obviously a lot more attractive than one that's done all right out of the crisis, but is up 30%. So
so I feel like, and I mean, you guys know this part better than I, but I feel like LVMH has been doing quite well. Kering's been doing quite well. I'm a little bit surprised actually at Richemont. I thought they would have probably done a little bit better, but they seem to still be a little bit flat. But they've got some crackingly exclusive brands under that banner. So they're one that I actually really quite like from a demand point of view and a sustainability of demand point of view. I don't know.
Yeah. And so just for
what your view is.
Yeah, and so I guess just for people listening at home, they're generally watches and jewelry And so, I mean, it's an interesting though. It's where they sit versus a swatch makes sense, but I guess maybe this is a point of where the demand for watches has fallen. And I think
some of that from China. Do you think just the fact that there's been a dramatic pullback in Chinese demand?
I think a big part of that would be, I think, I don't know about Richmond. I know with LVMH, I think something like 18% of their revenue comes out of China, or so it's quite a bit. So it might be similar because the Chinese do love those incredibly exclusive European brands. And you've got sitting in there Cartier, Van Cleef & Arpels, Jaeger-LeCoultre, Montblanc, Chloe, Piaget, Vacheron Constantin. So you've got some really, really top level watch brands in there, and the Chinese market has really been keen on those because they're just that next level up,
Yeah, because it's that it's a whole interesting part, isn't it? And with as you said, travel down. It's not that you can't buy some of these handbags in your Sydney store or your Perth store, but if you get to say, well, I was in Milan and popped in and I bought this, or if I was visiting Paris and so I dropped in and bought whatever it is, it's like a bit of a souvenir for the.
Got my tax back on the way home.
Exactly. Yeah, that's right. It's a lot of it. Paid for, well, I guess you're not flying economy if you're doing that, but paid for part of my business ticket to cross. So yeah,
that is a big thing. The other thing is some of those designers don't. Some of them aren't here in Australia, and some of them don't have online stores. So say Chanel and Dior, you can't buy online. You have to go into a store. So we have Chanel in Perth, but we don't have Dior in Perth. So unless you have the mobile number of a sales associate in the Eastern States who can do it for you, it becomes when you're kind of in, I suppose you can get people's numbers to be able to get things, but I can't just walk into Dior in Perth and buy something because it doesn't exist. So a lot of the European brand, like it's very hard to get Goyard, say, and Moynat, I don't think have a store in Australia. So if you can't travel and you can't buy online, the ability to purchase certain brands becomes very difficult.
Yeah, and I guess that's where I'm trying to work out, is picking my level as to where earnings can get back to. As we said, there's one part about have earnings held up, but if we're looking at travel restrictions for a long time, then it's saying, or limited travel, then it's saying, well, okay, now I need to just revise down. There's a permanent 20-30% hit to earnings.
And that's where someone like Moncler is interesting, because if you are already in Europe and you're in the north of Italy and you jump in your Mercedes and you drive to St. Moritz, that's not a problem. But, there's a lot of people in Australia who love going skiing and who might have gone to Japan or who might have gone to Europe. And because of that inability to travel, the people who don't normally live in those climates all the time no longer have the demand necessarily to be able to purchase something as specific as ski wear.
Yep.
So there's one that I think will come back in time with more travel being a possibility.
Yeah, well, and as we bought it, part of the hope was that, look, well, not the hope, but I guess the feeling is that they've been through their winter season, most of it already, and so there was a 6 month of reduced sales, and then things were coming back. But if things don't look like they're going to come back, then there's obviously another hit to that. In terms of earnings. Right, yes. Okay, so luxury brands aside, so the other thing I just wanted to, and we've sort of talked a little bit about it, but just wanted to sort of get some insights into sort of some of the overall policy sort of thoughts in terms of how we're looking at the coalition, in terms of what they're planning and what they're, so there's one part about, if we've got a broad overview of what the beliefs are, and it seems that up until recently, the beliefs were certainly that trickle down and tax cuts were working, would work, and we're not a believer of that. We sort of figure that's, well, from an economic point of view, it has sort of, we think, been shown not to work. Do you think they're close to abandoning that sort of, I guess, overarching narrative, or it certainly seems like there's a saying, well, if we just bring these tax cuts forward, then everything will be better?
Yeah, that'll solve all the problems. Look, there has been talk about the tax cuts coming forward. I think they probably will. My gut feeling is that they will pursue that. But, the 23rd, so is that next Thursday? 23rd of July, we're getting an economic update. So we are going to get a chance to see a snapshot of the economy as it is, because normally we have a budget in May, which we haven't obviously had this year given what's happened, which is totally fine. So it'll be very interesting to see. And what I think we will see is there's going to be that divergence of, you've had this massive increase in spending and this massive drop off in revenue. So it will be interesting what the government does now going forward to still be able to get the wheels turning on the economy, trying to get it to recover. There is going to have to be spending. I don't think anyone is suggesting, austerity worked great for Greece, didn't it?
Yeah.
So I don't think we're going to be able to cut spending at this very point, but there is going to have to be a way of being able to stimulate the economy. And look, part of it will have to be spending related. I'm not sure whether tax cuts will kind of give that quick kind of bump that I think the economy, that the government is hoping for. But I think we need to, I'm one of those red green tape people where I'm like, just take some of the shackles off business, let them do their thing, because the more money that they can make, the less that they can cut their costs, the better chance they have of moving forward. The government has spoken about a business-led recovery, but there's a lot of reform that's got to go into place before that's even a possibility. So for the moment, it has to be a government spending led, and I guess it just depends where that money is going to be spent is more the point.
Yeah, I guess maybe I should put it a different way. I guess what I'm trying to ask is, you went through the sort of Thatcher Reagan period where the answer to everything was deregulation, and whatever the problem was, that was your issue. That was your solution. And,
that was solution.
20 years earlier, it was whatever your problem was, well, we just need some more government intervention into that sector, and maybe the government buys a company in that sector and nationalises or whatever. And so
that didn't work.
No, that's all right. But I think the pendulum obviously swings too far in each direction.
Correct.
And I don't think I think we're still pretty extreme on the whole. Yeah, if we just let everyone do what they want, then if we give people tax cuts, more tax cuts, and it'll sort itself out. We've sort of swung a fair way to that, and it doesn't look like we're swinging back anytime soon, which is for me why we're getting more inequality popping up, and why we're still looking at luxury goods, as a
as a safe haven.
But if the ship is turning around, and I think in some areas it does, some countries it does look like it's turning around from saying, okay, maybe trickle down and tax cuts isn't going to work. Maybe we do need to go down the whole government spending and possibly even sort of MMT type spending. Then I'm like, okay, the game's changed. Whereas at the moment I still have the feeling the game hasn't changed, and there's a few sort of hardcore, trickle down will work. And if it didn't work last time, we just need to do more of it.
Yeah. No. I think that's a very fair assessment. Look, I think there does have to be government spending, and look, personally, I don't know. I think it all comes down to where the money is spent, and I'm not sure whether in a pure economic sense that really necessarily makes a difference. But if we can see more infrastructure, good efficient build of infrastructure, and I tend to prefer the spending that is a little bit more broad, as opposed to the spending that tends to cause bubbles and that sort of thing. Although I don't think we're going into bubble territory at the moment, but I would like to see spending into like really strategic industries. I would like to see spending into infrastructure. And I know the government has talked about, putting money into arts and hospitality and those sorts of things. But I do worry a little bit about government spending there from the point of view that, it will help with that very short term kick up. But if we are not going to be able to have tourism go back to normal for, say, 3 to 4 years, is the government trying to hold up that sector for that period of time? Are we going to see the growth come out of it in the medium term? And I don't really know what the answer is to that. I have my suspicions that we may not necessarily see that.
Yeah. Well, I mean, a good explanation I heard or a good lens to look at the whole crisis through is saying, there's sort of 3 different areas who can take the hit, or four different areas. Sorry, if you include the government. So you say the government can take the hit and just spend all this money and give it to everyone else, and everyone else is fine. You can say the owners of businesses take the hit, and they're the ones who get punished. The staff within the business are the ones who take the hit, and they're the ones that get punished from it. Or the landlords, people who own the properties, own generally the property, sort of take the hit. And the argument is saying, well, if you try and make the owners take the hit, then you need all these insolvencies, and it takes a long time for those companies to come back, because you need somebody to actually get out and start a new business and all that, and that's not easy.
Yep.
If you try and let the staff take the hit, then you end up this huge unemployment problem, which then creates more unemployment. Whereas if you let the landlords take the hit, then landlords will go bust, absolutely, but the properties will still be there, and the receivers will come in, and it's actually very quick to turn it back on again.
Yep.
But it seems we're pretty well set up to do things the other way, to say, well, no, we don't want the landlords to take the hit. We want the staff or the owners to take the hit. And so, yeah.
And that's what, and I think at the moment we're kind of going to see a bit of a spread between all 4.
Everyone's going to take some.
Everyone's going to take some.
Yeah.
Unless you're in the public sector, or there's certain parts of the market that aren't going to cop it as much. I think everyone's in line to take some. I think it'll be really, and I mean, you guys talk about property quite often, but it'll be really interesting to see if we do start to see landlords going bust, what effect that has on the property market, and then what effect that has on government policy going forward.
Yeah, well, the policy seems to be keep the housing market propped up at all costs.
At all costs.
Yeah.
Which I don't know is necessarily the right thing, but
exactly. I guess that's what I'm trying to get a feel for, this whole. If they're still moving in the trickle down tax cuts, and we keep the property prices from falling away too badly, then everything will be fine.
I don't think that's going to work.
Well, no, that's right, and that's what I'm worried about. Is that this was a solution to this is the John Howard solution. Yes, it worked 20 years ago, but it's not a we've sort of run the course on that, and so now we need something different. But it doesn't seem as if there's anything different coming out.
No, and the problem is that when you've had a growth period like Australia's had a growth period now of almost 30 years, there's a really good reason why we should have intermittent recessions, because then it means that when we have one, hopefully the adjustment can be a little less than, I feel like we've now gone so far, and there's been so many bits of policy designed to artificially keep property prices up, or artificially to do this, that and the other. And I wonder if there's going to be some sort of reckoning at some point, because you can't just hold everything artificially in the air, and particularly when you see something, if confidence goes and everyone stops spending or that sort of thing, you can't artificially create confidence.
No, it's a bushfire argument. It's like saying, well, if you have a medium-sized one or a small one every few years, then it clears out a bit of the undergrowth, which means whereas if you don't have any for a long period of time, then there's so much of this undergrowth and so much of this poor business practice that when you finally do have I think it really turns into a massive one. So certainly with you on that. Tim, we might just given in the interest of time, but is there anything else, Caroline, you wanted to talk about on policy front before we let you tell people where you can find hear more about you?
Oh no, I think we've done pretty well. The thing that I would like to see, in addition to the things that we've discussed going forward, I think the government is going to have to have a hard look at tax reform, things like corporate tax loopholes, and then the state governments obviously having a look at things like land tax and stamp duty and payroll. I think that would be really interesting. No one seems to be talking about payroll, and particularly for your larger businesses and your larger employers, that there can really bite. So payroll's something that I would like to see governments looking at. Yeah, they're probably my big ones. Productivity.
Well, supporters on the land tax. My one, I thought feels a relatively low risk one. Already they're doing it in ACT, where they've said, okay, we're going to gradually ratchet down stamp duty and ratchet up the property
land tax.
Land tax. You're saying, well, here's your opportunity to say, okay, we are going to, we need to stimulate the economy somehow. Let's just get rid of stamp duties and start building up the land taxes. And there's a 2 or 3 year period where gives everyone
take a bit of a hole.
Yeah, there's an incentive for everyone to get out and do it. And house prices might fall, but if house prices fall, but stamp duties fall, and then the price people are actually paying for a house is might end up staying a little bit more steady.
And I think too, it'll make transacting property easier in the long run.
Yep.
I mean, land tax has its own issues, but stamp duty does really become quite a bar to getting into the market or getting someone to buy your house. So it does really affect transaction costs. So I think if that wasn't there, you would see more movement.
Yeah, absolutely. And which is what you want. You don't want a widow with all the kids moved out, still living in a 5-bedroom house because they don't want to do the stamp duty of moving into somewhere smaller, which is a fair enough assumption. And the other part is that whole part about people got to travel across cities to get to their new jobs that are 45 minutes away, and they don't want to move because there's a $30,000 to $40,000 stamp duty bill if they do move. So
it creates that movability, doesn't it, or the mobility sort of factor of labour as well. So
absolutely. And that is huge from that point of view as well. Quite right.
And the whole NIMBY part is I think a perfectly rational thing to saying, well, if I've got an apartment going up near me and I don't want to live there, if it's going to cost me $30,000, $40,000, $50,000 to move somewhere, then I'm much better off picketing that apartment and stopping anything from going anywhere near me that I don't want. Whereas if it's I can move for free effectively, then there's less reason to be nippy.
We've had that recently in Perth, in Cottesloe, which is our leafy waterfront suburb. They wanted to put the council approved a skate park. The outrage, of the possible undesirables at night time. Oh, it's just divine. It's so Perth.
I'm sure there's there's a suburb or two in every major city.
It's just like that. Yep.
Yes.
Good. All right. Well,
excellent.
Look, we might wrap it up there, guys. So just before we do, though, Caroline, if you'd like to share with our audience how they can follow your work and get in touch with you.
Sure. So I'm on Twitter at Caro Di Russo, and if you happen to have a penchant for luxury goods, I'm on Instagram at _daily_lux. So that's where you can find me.
Fantastic. I just hope my wife doesn't listen to the podcast this week and burn up all our spare money. But look, thanks very much for sharing your time today. It was a terrific chat. Covered off some terrific areas there as well. So greatly received, and we certainly look forward to getting you back on the show soon. So thanks again for calling in.
Absolute pleasure.
Lovely.
See you later, gents. Bye.
All the best. Just finally, so we hope you enjoyed today's show. If you'd like to see more of our content, head over to nucleuswealth.com/content to stay up to date with news from us. Follow us on social media. We always appreciate guest or topic selections, so if you've got one, drop them in the comments of today's YouTube video. And finally, of course, if you know of anyone that would like to get something out of today's episode, feel free to let them know about it, and of course, let the podcast grow. So on that note, thanks for tuning in, and